Hey everyone! Welcome back to the channel and to part 2 of our finance series. In the last video, we talked about what business finance really is and why it's so important, even for small creators and students just starting out. Today, we're diving into something even more practical. Where does the money come from when you want to start or grow a business? That's where the concept of sources of finance comes in, and the two main types are equity and debt. Let's break this down clearly, simply, and with real-world examples you can relate to. Why you need finance in the first place. No matter how small your business is, whether you're selling on Instagram or starting a full-fledged brand, you need money to buy products or raw materials, run ads or marketing, pay for delivery or packaging, maybe even hire someone to help you. That money has to come from somewhere. And how you choose to bring that money in can completely shape your business journey. Source number 1, equity finance. Let's start with equity. In simple words, equity finance means raising money by giving someone ownership in your business. You don't repay them like a loan. Instead, they become a partner or investor, and they share in your profits, and sometimes even your decisions. Example, imagine you start a small t-shirt business, but you need $20,000 for inventory. You ask a friend to invest $10,000, and in return, you give them 30% ownership of your business. If your business earns $1 lakh later, your friend also gets 30% of the profit, because they now own part of it. Key points about equity. You don't have to repay the money, no pressure of EMIs or interest, but you share your profits. And sometimes, you lose some control too. When to choose equity. You're okay with sharing your business. You need a large amount of money. You want long-term growth without loan pressure. Source 2, debt finance. Now let's talk about debt, which basically means borrowing money that you'll repay over time, usually with interest. This can be from a bank, business loan, government scheme, NBFC, friends, family, even personal savings if you treat it as borrowed. Example. You borrow $10,000 from your father to buy raw materials and promise to pay it back in 3 months. You don't give him any share in your business, but you have to return the money, possibly with a little interest. Key points about debt. You keep full ownership of your business. You're in control of decisions and profits, but you have the burden of repayment. Late payments can affect your credit or trust. When to choose debt. You want to keep full control. Your business can afford to repay monthly. You're confident about income coming in soon. Equity versus debt. Quick comparison, factor, equity, debt, risk, lower financial pay. Repayment required? No, yes. Ownership shared? Yes, no. Control, partial, shared. Full, you own 100%, risk. Lower financial risk, higher pressure to repay. Suitable for long-term growth businesses, stable, cash flow ready biz. Which one is better? There's no one right answer. It depends on the size of your business, your risk-taking ability, your income flow, your personal mindset. Some successful businesses started with just $5,000 in debt from a family member. Others raised equity from angel investors even at an early stage. What matters is, do you understand what you're giving versus what you're getting? Never take money, equity, or debt blindly. Understand the trade-off and choose what aligns with your values and business plan. Bonus tip. What if you're just starting and have no money? You can also explore bootstrapping, using your own small savings, grants or student competitions, crowdfunding, online fundraising, selling digital products, zero inventory required. We'll cover these alternative options in upcoming videos. Final thoughts. So that's the basics of sources of finance, equity versus debt. Two powerful tools, two very different mindsets. Finance isn't about being a math genius. It's about being smart, aware, and intentional with your choices. If this video helped you, drop a like, hit subscribe, and comment below. Would you choose equity, debt, or bootstrap your own idea? I'd love to hear your take. Next up in this finance series, we'll be talking about something very practical. Financial planning and budgeting. It's time to learn how to make a money plan for your business, and stick to it. Until then, stay curious, stay focused, and keep building smart. See you in the next one.